Hi, I'm William F. Bryant, and this is my VOPED podcast. Today I'm going to talk a little bit about risk factors and risk for a company. The reason why I want to bring this up is because the general supply chain crunch that we saw and are continuing to see probably was a really big wake-up call for a lot of companies. Because too many companies became lax in letting their operations just kind of run themselves. And when you automate or digitize, add a lot of technology applications, whatever, you do tend to see that everybody wants to make use of technology so they can save time, but what companies really have done is attempted to pay less money for positions, saving on brain power, and hire people who probably shouldn't have been in the positions they were in, but are using the technology as kind of a crutch. And that can happen to a degree. If you go back to any of your basic maths, I still came from the analog generation where you did everything on pencil and paper, and you can actually show that doing things on pencil and paper create different lighting up of neurons in your brain, and so you have different pathways on how you learn as opposed to just doing things on a computer or something, calculator even. We weren't allowed to use graphing calculators. So a lot of the things now, you wouldn't necessarily even have to know how to go through the steps to solve a problem, and the algorithms or how the application is set up will spit it out for you. You can see this all the time on websites that are really just kind of like math-based fun, or a lot of financial sites where they'll do calculations for you for, say, bonds or equity valuations for stocks when you're figuring out price to earnings ratios or something like that, because all of this stuff is just formulas. And so they plug them in and it'll solve it for you. And maybe you get a good idea, maybe you kind of understand what it is, but you can't really do it. All of these things are actually contributing to risk within your corporation. And people don't understand that technology added, applications added, all of those things also add risk. They're not just risk that your system might go down or it might be hacked or something like that. The crutch that it becomes is also a risk in your organization. Now, maybe I should just kind of like, risk is an all-encompassing factor. It's not just something that's a catastrophic event. There are all kinds of levels of risk. And what you do within a corporation is identify levels of risk and where they're going to be at. And these tend to be things that are going to be detrimental to your expectations of cash flows for the most part. Anything that's going to affect your bottom line in an adverse way that you did not expect is going to fall under the classification of risk. Now, as I was saying, all of the things when you go into training and hiring and people, all of those are also risks that are inherent at probably the most, as internal of a level as you can get in your corporation. Like, I mean, you can branch out and you can look at machines and operations and processes and all of this stuff. But at the most core level, it's the people that you have operating things and using the systems that you have that are your very, 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 very first layer of risk. And probably the most concerning piece of risk, aside from catastrophic events outside of your control, which would be, systematic in the market or maybe even systemic risk. Now, I bring this up with people because, as I said before, if you listen to my HR video, the people in HR have a job to do in terms of compliance, training, benefits, and all of these other things to make sure that your workforce is skilled enough to handle the job. the fact is that really, most of the training that is involved in any kind of a position, and I've been on entry level and managerial and all those different things, it's not remotely sufficient enough to cover even the most beginning or entry level of positions. It lacks. And so to then throw in there and bunch in the actual hiring processes for them was not very well thought out, and this is all contributing to your very first layer of risk within a corporation. Now, when you are attempting to do a cost-benefit analysis, one of the first things that you have to worry about when doing it is, what does it actually cost you to implement a procedure to save you from certain risk? Now, at the entry-level positions, it saves time and therefore money to have somebody else do the hiring. Entry-level positions are not ones that necessarily require a substantial amount of skill or know-how, and they're not really expected to be at a level to make a vast contribution to the company initially. They're going to generally do what they're told in tasks that are delegated to them. And so to actually have somebody who doesn't necessarily know a lot about other operations, other areas of the company hire these people, that's not really a big loss. That's not really a big risk. They're not, as I said, they're not going to have a major contributing factor to the overall store or company. And yes, you could argue that there are possible customer service issues or something of that sort, but really, I'm just kind of looking at broad-based terms and what you can actually crush in terms of cash flow. Of course, you could discuss boycotts and things of that nature too, but just broad-based here. As you move up in levels, when you go to managers and directors, and then VP levels, and up the chain, and all middle management in between, however you're going to classify them. The more specific a position is to a particular area, and the more people you're overseeing, the more the impact that position is going to have, obviously, on the overall operations and therefore cash flows of that company. Those people are going to have substantially more risk associated with the position than any people below them. It's a step-up process, right? However many more operations or people or procedures that you're in control of, there's much more risk. Now, you can't have an area delegating a chosen pool of candidates from a bigger pool to basically say, here, hire from these because we approve them, when the area has a skill set to even work within that area at any of the middle managerial levels. And this is just blunt truth. It would be similar to having a grade school math teacher attempt to hire for a college chemistry professor position. I mean, you just wouldn't do it. You look at credentials and stuff, and even within the university system, your peers do the hiring. I mean, that's how it works, because they know what's expected of you, and they know what you have to know to be successful in that position. That should be an indication right there as far as required knowledge to even have an understanding of what the position entails. What you see are algorithms which select candidates based upon keyword phrasing that actually, when you get in the higher level positions, could be a myriad of things. For example, in finance, awful lot of positions always list cash flow analysis. Well, cash flow analysis can fall under a number of different areas. I mean, you can be really good with operational and working capital cash flows, and you could put down DCF models or DDM models, but you're not going to just put down cash flow analysis if you're at a higher level. If you're at a lower level, you might put that on your resume, but you're not going to put that if you're at a higher level and you're actually concerned, because all of the different things, whether you're doing FP&A or M&A or really anywhere where you're doing any kind of strategy planning and funding, you're going to do cash flow analysis. You have to. It's a basic It's a basic fundamental assessment. But you're not going to list the building blocks of where you're at to get to whatever assessment that you're doing. And so you're not going to use basic terminology to do a position. It would be similar for an accountant to say, yes, I can do bookkeeping, even though they've got a CPA. It's like it just doesn't make any sense to include these things. If you or if you had a corporate financial analyst certification that you knew how to do cash flows, or you knew how to do financial analysis, like you shouldn't have to put all of those things down, but you do, because the people who are doing the hiring for you don't understand what an entailed positions, don't necessarily understand what certifications entail. And yeah, you can always argue that there's a handful that do, but the vast majority within that departmental area do not understand all of the aspects. And I'm just concentrating on the financial side because that's just the side that I tend to focus on. But if you went into operations and you were talking about different levels for, I'm just thinking, mechanics, welders, electricians, or even engineers, all of the things that they're doing and in their base knowledge isn't necessarily going to be concluded, because then you have pages and pages and pages of CVs and all of the information of all the different things that you could do, all to make up for the fact that the people who are doing the hiring don't have the knowledge depth to understand all the different things that each position entails. Now, and then you're reliant upon whatever the last person who put in the description is for these given job descriptions. And I'm not really the only one who feels this way. You can go through and you can talk to a number of people who have significant work experience or managerial experience, and the frustrations that build, because in the end, when you actually go to see how the hiring works out within your workplace, oftentimes you're looking at probably 50, 60, maybe even 70%. It comes from recommendation from somebody who's already there. Depending on the level it's at, you then either have external talent acquisition, or headhunters, as it would be, or temp agencies that bring in people. And then you get maybe 1 out of 10, maybe 10% of your hires actually come from your HR department. Most of that, once again, goes back to that you're using technology, but again, it's a contributing factor that people doing the hiring don't have the know-how to know all of the different areas. It's a complete misallocation of funds, and it's a risk actually for your corporation. I strongly believe that that is the reason why we now have the number of zombie corporations that we actually do out and about. And I mean, that's an external contributing factor to the amount of money that's being printed by the Fed, but nonetheless, that in itself is also a risk, which I'll talk about here in a second. But the very first base risk I wanted to address was that, because there should be cost-benefit analysis in terms of time and actually grabbing the best candidate for a position. Those two things are your biggest risk factors. And like I said, the higher up it goes, the more important it is to have somebody who actually understands the position, look over the hiring. Just a quick example. I had done an interview for a pension consulting firm, and the actual team manager did the selection process. And I don't doubt that he was able to do it in maybe 20 minutes a day. Right at the end of the day, he could page through probably 30, 40 resumes, because he knew exactly what was necessary and exactly what background would be needed to even have a hope of being successful within that position. And you go through 20, 30 resumes a day, and you can probably go through them. A number of times it's just formatting. I mean, you can eliminate people with format for given positions, but then you really just have to look at quick glances on positions, and you can narrow it down day by day, and you can probably hit, like I said, 20 to 30 a day. You get 100, 120 by the end of the week, And at the end of the week, you do your final comb over. Before you then move on to Monday, you make your calls for the maybe 5 you selected, and poof, you're done. 1 week, you got your position. And it really can work this fast. If you're having higher turnover than that for positions that are managerial in nature and oversee an area or department or even a number of people in departments and segments, then there's something wrong with your company, and you should probably address that factor. Now that I've kind of said my piece on that, moving up and out from that, other risk impacts that work within a corporation obviously come into play. Money that exchanges hands. So another internal risk factor, you have cost controls put in, usually by your controller, overseen by the CFO and their selection process. But if you watch on finance account and in my accounting segment, then you see that there is a difference between the positions for financial folks and accounting folks. Not that there isn't some blending and crossover, but they do have different designations for like specific skill sets and where that they should put those skill sets to be optimal for your company. And so you have controls in your processes for all money handling or any cash flows going in and cash flows going out. That's another risk area and another way that risk is mitigated within an area. When you move up from there, then the risks go into actual operational things, and they can be anything from accidents to broken tools, broken machines, or anything really that's going to affect work. And usually that's in work stoppages. When you move up from there, you're obviously looking at raw materials and inventory and the way it moves through. So you have bottlenecks and just capacity issues that you have to address. When you move up from there, and that's why I call it wall to wall on supply chain issues, because it's basically from when it comes into your dock to when it goes out. So anything between the walls. But your risk really doesn't stop there. It goes beyond that. And we saw that with supply chains and so on. And actually lack of workers, but I mean, really they're inherent in the supply chain. And so I tend to think that you should look a couple upstream and pay attention to at least immediate downstream, if not a second step downstream. The reason why, I mean, once again, it goes back to the cost-benefit analysis. How deep do you go? How much time is it going to take? And then that reflects how much cost it's actually going to go into any kind of analysis or reflection on the risk that you have in your company. The supply chain one, though, is a pretty big one. As you saw, if you don't have materials coming in, you really don't have any products that you can make. Our microchip issue is a perfect example right now. You have lots filled with trucks and automobiles that cannot be completed because they do not have the chips to complete them. I would go a step further and say that our risk isn't just in the supply chain of chips. I would say that risks are inherent in technology, and there is a benefit to having analog systems. I might even go so far as to say the risk in itself is technology. And I'll explain that in a second. I'll explain it now. Fine. So when you have risks in a process, right? If it's a completely analog process, the only risks come in the people, the tools, and the materials. As soon as you add technology in your process, the technology itself then becomes an additional potential for risk, especially if something in that technology malfunctions and it no longer allows the process to continue. A good example of that is, I'll go back to automobiles. Certain automobiles have so many sensors on them that if something goes wrong with that sensor, and just the sensor, not what it's sensing, just the sensor, then the automobile is kaput. It's done. It will not operate. And so whether or not it was just simply the sensor that malfunctioned, or whatever it was sensing caused the malfunction, you don't really know and have no way of doing it. But either way, you have a brick for a car. It's not going anywhere. And that's just one example in terms of machines and reliance upon technology. If it's interlaced in the operations, if it's just simply, if your technology is just simply doing things to help speed along the process time, or sensing specifications and measurements and then letting you know when you're out of spec, but it doesn't actually stop the process, that's a different issue. So you have to examine also what is in the process, because a lot of your risk mitigation goes into the process. If it's an analog risk control or risk mitigation device in the process, obviously that's much easier to control than if it's a technology that completely shuts down, and then you have to go and get a new sensor or a new hard drive or something that actually lets you continue the operation. So in the technology itself, just in its ability to operate is risk, let alone how the algorithms that are put together within the actual application, and whatever data that they're setting out, that's also a risk. Because there are, and I think I could just use Excel. I'd have to go back and look, but I know when going through and examining different statistical data, you had to be aware it was in IRR calculations, because the way it handled IRR calculations was a little bit different than you might do if you were doing them on, say, your calculator itself. The way it handled the cash flows, and I believe it was the initial cash flow and how you had to do all of your negative out and your positives in, and the way it calculated it out. I'd have to look it up again, but I know that there was a little bit of a warning in using it and remembering how to use it. And that goes the same for any application that you're using within the company. And it goes back to the people who are being trained again, and whether or not they actually truly understand what it is they're doing, and how and the entire hiring process it was in the first place. If you had people within a department hiring, then you'd already know the person actually knows what's being spit out. And if you told them what the algorithm was and the formulas they were using, they would probably be fine with it. Somebody else, maybe not so much. And so you're then looking at entirely relying upon the technology that is running your corporation. And you see this all of the time, and I think you're going to see it get significantly worse as we go along. Bearing in mind that the macro events don't culminate to a point that affects the entire economy and all the businesses within it. Anyway, stepping out from technology and going back to upstream supply, understanding your suppliers and where they're getting their supply from. And it depends on where you're at in the supply chain. What part of the processing before you finally get to that end customer user are you at? If you're relatively close to the raw material folks, then you might want to keep track of miners or loggers, or maybe it's paper millers, or the actual like for the chips, the actual people who pour the molds for the chips and do the process. The process has probably changed. I do remember that there was a dip process for electronic circuit boards, so you got the correct wiring pattern in them. Maybe they do it differently now, I'm not sure. I just remember that from electronics class. But nonetheless, you've got different people who are going to do different things along the chain, but you want to know how they're doing and whether or not the supply that they need to keep operating is flowing, and how things are progressing or occurring in the areas where that supply is coming from. It would also be beneficial to know that if you can possibly find other people who would be alternative suppliers for crucial parts, if you if you couldn't get your main supplier, and perhaps even to do some ordering from that supplier just to maintain or either begin or maintain some kind of a relationship with that person. Understanding their capacities wouldn't be a bad thing either. But that isn't always possible. You're not going to find out all of the intricacies of their operations and what they're doing. However, estimating it wouldn't be a bad idea. Now, same goes on your customer base. One of the key things when you do any kind of M&A transaction is to understand whether or not the customers for the company you're taking over, what level they contribute to the overall sales of the company. Now, if you only have one or two primary customers who contribute maybe 50-60% of your sales, that's not really a good thing, because if either one of those start to have cash troubles, then you're out 50% of your sales, just like that. Poof, it's gone. And so you really need to understand who is purchasing your supply and where they're at solvency-wise, or even the next level down, who they're selling to, and figure out how your operation sits in the overall chain and whether you feel like you're fairly secure or not so much, depending on your upstream and your downstream. These are all additional risks that go into your operations. And then, of course, you go bigger and you have your macro risks, which you can't really tend with, but interest rates and funding of government debt and government expenditures and contracts and all these different things, because if you go through Keynesian theory, they flow money through the system, and that money is going to somewhere affect the end customer and their purchasings. Now, at this point, I would go further into the inflationary impact and what we're dealing with, but that's more of a politics, finance, economics section, and not necessarily risk for a company. So when you're looking at, just go back to the risks now here. So when you're looking at risks and mitigations, you look at each level. You can start at the base, internal, and then work your way out. But don't forget to include your upstream and your downstream. And the depths at which you go into your analysis and your recordings. And a lot of companies may already have this. If you're newer and you haven't done this, it's pretty essential that you do it. And the first one is probably going to be time consuming, the most costly, just because you need to have a reference map of sorts, and then you can detail it along the way if you need to as things change, and maybe do some oversight into it. But within your operations, within the walls, you should have managers who are recognizing a lot of things that are going wrong, and cost control systems and process control systems should be in play, so you get some kind of alerts as to something that's going wrong. From time to time, usually probably quarterly or every couple quarters, you should do some kinds of checks on your upstreams and downstreams. Now, when you're doing your risks, you kind of make your list and you determine severity and frequency. And what that comes in is how often that event can occur and how much can we lose if this event does occur. And that's your severity, is how much you can lose, and frequency, how often it occurs. By understanding those two things, you can address whether you need something specific to mitigate that risk, or if it's something that maybe you can let alone because it'll cost you more to mitigate that risk than to actually just let the risk go. Some, however, you find in accounting and financial controls, sometimes risks, you find that there's a very low severity, but a high frequency in one area, but just up the process, there's another area where there could be significantly higher severity and maybe the same frequency, and so you put a more tighter control here than you do here, just because that control system may catch all the stuff that comes up from there. So you still have controls in place when you're actually looking at the risks for your firm. Now, when you're looking at mitigating risk, it's not just up to you necessarily to figure out ways to put in processes and controls. Although you really want to do this for most things that have some kind of a risk. For example, if you've got trucks that are doing your distribution, you may encourage a walk around. Make sure, hey, all the tires are working. All the locks on the doors are good. Things like that. Anything that can mitigate loss or breakdowns or something later on. Scheduled to maintain when you're actually going to do repairs and oil changes. Certain things like that are all things. But you notice how all those things take time, and that's where the cost comes into play for those. But you also have other things that insurance companies are specifically designed to basically take on the risk that you don't want to, or you can't deal with on a regular basis, because maybe it's more severe but lower frequency. And then a lot of insurance is actually necessitated by government and compliance. So things like that, workman's comp, it's necessary in 49 states. I think Texas is the only one that does not have a workman's comp for businesses. But there might be another one. I'm fairly certain that's the breakdown on that one. But if you have an employee get hurt, that covers that. Then there's obviously general liability if customers or something get hurt within your store. Most of the customer service centers would have that. There are D&O, directors and officers insurance, for things that your shareholders might sue if there were decisions for your directors and officers. That risk may be during their time period. I believe you can also get extensions for if they've quit their tenure. There's umbrella insurance to cover any costs above and beyond other insurance coverage. You have political risk insurance. You have insurance to protect against basically loss of income if you don't meet what you believe to be your perceived payouts from a given strategic endeavor. There are insurances for pretty much anything that you can price out and get a value of. An insurance company, and you might have to go to one that specializes in unique circumstances. I mean, you have things that are named perils, and or all perils, and that'll break down to these kinds of situations that you want to have covered. But if they can price it out, they can give you a premium for it, and as long as you're willing to pay that premium, then they'll cover the cost. Now, you notice I said you'll have to pay that premium, and that's because insurance companies deal with that moral hazard and adverse selection for that matter, where people who need the insurance are going to be the ones who buy it, number one, and so they're almost, I don't want to say they're certain to have an incident which is going to result in a payout, but they're probably going to have one at some point. And then of course you have the moral hazard part, which is because you have insurance, you might be a little bit more casual about avoiding the risk because someone else is already covering the risk for you, and so the premium has to be high enough to kind of make you aware of the fact that you should still mitigate the risk to the best of your abilities, and that's where that comes into play. And so for all of the risk that goes in, there are different things that you can do. Some firms even go into hedging, especially if you're a firm that relies heavily on commodities and you want to hedge pricings out on the commodities. Really, I mean, that's probably the best area that works out in, because you can set the price that you want to buy or sell at, and somebody else will pick up the contract. And you usually can do that with futures on the market. If you have to do ones more specific, you can do a forward. But I mean, you have to pretty much be guaranteed to use that forward, because there's no one else who's going to come along and buy that. It's going to be set specific for your company with another company, where a futures contract at least will have the market, and possibly somebody else will pick up the tab if you're doing if you're doing commodities. You can also use options and such, but there isn't a lot of hedging that a company can do using any of those things. Like I said, unless you're actually dealing in commodities, or you find something against which you can hedge against. For example, companies that deal in foreign exchange risk might find value, or if they've taken out a significant portion of debt, and depending on their credit level, maybe they were only offered a float and they wanted a fixed payment. And so then you have credit swaps that you can do, and interest rate swaps, and you can find people who would be willing to buy and swap contracts for those things. Credit would, for the solvency issues, if somebody wasn't able to pay you back whatever they were paying, and then interest rate for the change in interest rates. But aside from those things, right off the top of my head, I can't really think of other areas that would use as far as a business goes. Another technique for mitigating risk, maybe your usage of leasing. And so you can do leasing analysis when you want to determine whether there's a fixed asset that you want to purchase or you want to lease. And then there are a couple different methods for leasing. You have operating leases and capital leases, and those just vary in, who really gets the right to depreciate the asset. And so on a capital lease, you'd be depreciating it, and if it was on the operating lease, the person who actually, on the operating lease, the person who actually owns it would be the depreciating, and you would just be writing off the payments as expenses. And so there are some in there, and it gets, they did do a law change, I think in 2019, on the way you record leases and the guidelines for how you have to record them, because there's all kinds of issues with the life of the machine that you're going to actually be leasing, and whether the lease payments add up to the total value of the machine or fair market value, and a lot of accounting issues that go into that right off the top of my head, I don't know all of them. But if you're looking at perhaps stretching out your cash flow as much as you can, perhaps an operating lease would be just fine for you to go under, or maybe a capital lease, depending on what you're looking to do. If you're looking to maybe purchase the asset at the end of the term, that would free up some cash flow. One thing though, when I would say using that for freeing up cash flows, and maybe using that to make sure that you have enough cash on hand, is kind of like a cash budget risk technique, is to go through, and because I always believe if you own it, you can always use it. Now, there are a few exceptions to owning and using, but if you own something, you can always put a lien on it later on if you own it outright. Now, the exceptions would be if it's a technological device in which you see changes every couple of years, and that's possible. I mean, with the amount of technology and how quickly things change on phones, cameras, computers, laptops, it is possible that you're not going to get the most out of it if you have to actually purchase something. A good example might be medical machinery, for example, LASIK eye surgery machines. Those machines were a big chunk of change to purchase, and if they came out with a new model in a couple of years and there were substantial improvements to that model, well, then you're out whatever it was that you just purchased on that machine, unless somehow you can do upgrades to that machine to bring it up to par where you're at currently. So that's an example of what you might want to lease. But otherwise, major components in operations that you need to make a product, it's probably better to own those, because if you need to do a lien on it, you can always work out financial engineering things if you get into solvency issues where, for example, everything that's made on that machine that comes out on the line, that there's a portion that's held aside that relates to that, and so it eats into your margin for each product that's put out, and then that's set aside to make a payment to somebody else. For an example for that, one example that I was given was a company was making, they were cranes, and so they had to be supplied with a particular component in order to work the machinery on the crane. And there was one company that supplied these components. Now, the company itself that made the cranes was having solvency issues just because of other suppliers not really being able to pay their receivables. Economy took a downturn, and so everybody was kind of stalled, and there just wasn't a lot of liquidity in the system. So what happened was that they were able to get funding from the company who actually made those components, by saying that every time one of the cranes rolled off carrying them, they would set aside a portion of whatever the sale was so they could do a direct payment back. And so really they were doing a kind of like a usable life thing in accounting, where you determine how many units something can make, and each one of those units, a portion of it was going back to them, and that's the way they were directly relating the amount of productivity to what they were going to be receiving, and so they worked out that deal, and so even with the machine itself that would be doing it, you could work out something like that as well. That's one thing about financial engineering. It seems like there would be set patterns, but as long as you can come up with a legitimate method for which somebody can receive their money, and it seems like it's going to work, and you can show how it would work, they very well may actually take you up on that offer. The provability is just simply that you actually are able to still make whatever components or products that you're making, and there's still a buyer. As long as there's still a buyer and you're able to make the components, then you're able to generate sales, and that's the biggest issue there. Let's see. So I talked about insurance, a little bit about processes within the company, a bit about technology and human capital. And if you don't understand, again, on that, like, there are people that are worth more to your firm than others, and you need to select those people, but only people who are within those positions can really select the people who are brilliant within those positions. That's how it goes. It's done in a number of industries, but somehow it got blended and mixed up within corporations. Let's see, what else? I think as far as risk goes, that's, identify and make a schedule, figure out severity and the frequency, figure out what you can do to mitigate it, figure out where it is in your process pattern, and if somewhere else can be a mitigation technique. And once you figure out what it costs to introduce some kind of a mitigation process, you can then decide whether or not you are going to commit to that or not, depending on the benefit that comes out on the other end. And that's your risk area. So